Chapter 6, Segment Reporting. Hello all. As promised, this video covers the concepts to be learned in the second half of Chapter 6. This will be short and sweet. The topic covered is segment reporting. The must-know includes 1. Knowing the difference between traceable fixed cost and common fixed cost. 2. Knowing the difference between segment contribution margin, segment margin, and net operating income. 3. Knowing how to prepare segment income statements. Let's start off by talking about organization types. Organizations can be broken into two types of categories, either centralized organizations or decentralized organizations. In a centralized organization, the executive management basically makes all decisions. This type of structure is typically good for small companies offering a single product. As businesses grow, management of the organization becomes more and more difficult. Most of the large businesses are decentralized, meaning that authority to make decisions is spread throughout the business itself. As business entities become more and more complex, the management of these firms often find it useful to divide the company into segments in order to enhance their managerial planning and control over operation. Segments usually are based on organization units, like divisions or departments, or areas of economic activity, like geographic regions or product lines. Many large companies have found that segmentation by organizational unit is the approach that proves to be most useful. It's important that managerial accounting systems and procedures that develop information for planning and control decisions be structured to reflect the segments that the business operates in. Before we go any further, let's make sure you know what a segment is. A segment is a part or activity of an organization about which managers would like cost, revenue, or profit data. Examples of segments are divisions, sales territories, individual stores, service centers, manufacturing plants, marketing departments, individual customers, and product lines. On this slide, I give you an example of the segments that would work for Apple. Apple could have divisions, and the divisions could be broken down into product segments or service segments. The product segments could be broken down further into iPhone, iPad, and Mac. The services could be broken down into Apple Care or Apple Pay. These are all segments. Geographically, they could be broken down into America, Europe, Asia. Sales territory within the Americas could be a north, south, east, or west segment. And then finally, delivery channels could be segmented into in-store and online. So how far we want to segment a company depends on the kind of information we need to move forward. When businessmen talk about segments, they typically break them down into 4 types. They're either revenue centers, cost centers, profit center, or investment center. The manager of a revenue center is responsible for sales only. He's not held accountable for controlling cost, and an example here would be the sales manager. On the other hand, the manager of a cost center is responsible for controlling cost. And examples here would be the manager of the accounting department, the manager of HR, and the manager of information systems. A manager of a profit center is responsible for revenues, for controlling costs, and overall profitability. Managers of profit centers are held accountable by comparing actual profitability to budgeted profitability. So an example here would be if you were the manager of a retail location. The manager of an investment center is responsible for revenue, controlling costs, profits, and investing in assets. What type of assets? It might be security portfolio. It might be in new locations. It might be in new equipment. In this individual's case, actual returns are compared to budget. So again, an example would be the regional manager for a retail location. Internal reporting of segment operations deals primarily with the measurement of operating performance of the segments involved. As a result, segmented reports usually take the format of a contribution margin income statement. Contribution margin income statement allows managers to identify those costs that are controllable by the segment and for which a segment manager should be held accountable for. The use of a contribution margin income statement requires management to segregate those costs that are attributable to the segment from those costs that are attributable to other segments. Department managers should be held responsible only for costs and expenses that they control. Therefore, in segment reporting, costs are commonly classified and reported as traceable cost or common cost. Traceable expenses are those operating expenses or costs traceable to and incurred for the benefit of a single department or a single segment and thus ordinarily controllable by that department or segment. Common expenses are those operating expenses or costs incurred for the benefit of multiple departments and thus neither traceable to nor controllable by a specific department. It's important to realize that fixed costs can be either traceable costs or common costs. It's important also to realize that we will only hold managers of segments responsible for those costs that are traceable to their operations. It's important to recognize that common costs should not be allocated to the different segments. As can be seen on this slide, building the contribution format income statement is similar to what we've been doing all along. You are going to take your sales, you're going to subtract your variable costs, but now you're going to have a segmented contribution margin. Following the segmented contribution margin are the traceable fixed expenses. Once you subtract the traceable fixed expenses from the segment contribution margin, you get the segment margin. From the segment margin, you'll subtract common fixed expenses to get the net operating income. So the big differences here are the terms segment contribution margin. The second is traceable fixed expenses. Then third, segment margin, common fixed expenses. And then ultimately we get to our net operating income. The financial statement is similar to what we've done before, but now what we've done is we've added columns for each of our segments. So again, those segments 1, 2, and 3 could be product A, product B, product C. It could be the North Division, the South, the East Division. It could be online services, in-store services. So the segments can be whatever we're drilling down to get good data for on our operations. Once you input the data for each segment, then the total is just the sum of each of those columns. So the sales total would be the sum of sales for segment 1, 2, and 3. Variable product costs, same thing. Variable period costs, exactly the same thing. Then the segmented contribution margin is the total of the contribution margins for each of the segments. The traceable fixed expenses is the total of all traceable expenses to each of the segments. And then the segment margin, same thing. It's the total of the segment margin for each of the segments. At that point, though, you're finished with the segment part of the report. The only thing that's left is to subtract common fixed expenses from the segment margin to get the net operating income. You notice that the common fixed expenses are not allocated to any of the segments because we could not effectively trace them to each of those areas. So the segment margin again is computed by subtracting the traceable fixed costs of a segment from its contribution margin. The segment margin itself is referred to as the best gauge of long-term profitability for the segment. So when looking at segments, that's what you're looking at. Once a company prepares a contribution format segmented income statement, it can use the statement to make decisions and perform break-even analysis. Because we just recently studied break-even analysis, let's see how it would apply to this statement. If we wanted to know the break-even dollars for the company as a whole, in the numerator we would have to add the total traceable fixed expenses to the total common fixed expenses, and then divide that by the overall company contribution margin ratio. If we wanted to determine the break-even dollars for each segment, we would take the segment's traceable fixed expenses and divide it by the segment's contribution margin ratio. Well, that's it. I told you this would be short and sweet. So the key here is to recognize and understand what a segment is. Second, to understand the difference between traceable fixed costs and common fixed costs. To understand that it'd be a mistake to allocate common fixed expenses to segments because they can't be traceable and they don't really impact the performance of a specific segment. In other words, if that segment was gone, that common expense would still exist. Where when we talk about traceable fixed expenses, if the segment's gone, so are all the traceable fixed expenses that go with it. And then last of all, it's to make sure you're understanding the difference between the segment contribution margin and the segment margin. Done with another chapter. Thanks for watching the video. Time to do some drills with segment reporting. Good luck.